Booyah! Bruno's Global Economic Blitz for June 4th, 2025. Are you ready to make some money? Welcome to your Global Economic Calendar for June 4th, 2025. Let's dive into the key economic events and market updates from around the world. I'm Bruno, and you're here because you're smart, you're savvy, and you want to know what's moving these markets, what's shaking the trees, and where the opportunities are hiding. We've got a packed show today, folks. A real humdinger, from the good old USA to Europe, all the way to Asia. So grab your notebooks, get your game faces on, because knowledge is power and power means profits. Ding, ding, ding. Let's get to it. We're not just scratching the surface today. Oh no, we're going deep, deep, deep into the numbers that matter. We're talking PMIs, CPIs, PPIs, the whole alphabet soup of economic indicators that tell us whether the bulls are running or the bears are growling. And it's not just about what happened, it's about what's to happen. We're looking at market expectations, central bank whispers, and geopolitical tremors that could send shockwaves through your portfolio if you're not paying attention. But you are paying attention because you're here with me, Bruno. So buckle up, buttercups. This isn't some sleepy economics lecture. This is about actionable intelligence, understanding the cross-currents, and getting ahead of the curve. We've got elections, we've got commodities, we've got crypto, a veritable smorgasbord of market-moving madness. Are you ready to navigate this? Are you ready to understand what the big players are thinking? Then let's not waste another second. The bell is ringing, the game is on, and Bruno is here to guide you through the economic jungle. Roar! All right, folks. First up on the docket, the U.S. Services PMI scheduled for release at 10 a.m. ET. This is a big one, people, a real temperature check on the largest sector of the American economy. Are consumers still spending? Are businesses expanding their service offerings? Or are we seeing a slowdown that could make the Fed think twice, maybe even 3 times about their next move? This number, my friends, isn't just a number. It's a story. It tells us about jobs, about confidence, about the very pulse of Main Street and Wall Street. You ignore this at your peril. I want to see strength here, real backbone. But we got to be prepared for anything. Tick-tock, tick-tock, the clock is ticking on this release, and the anticipation is palpable. Now, what are we looking for? If this PMI comes in hot, hotter than a habanero in July, it could mean the economy still got legs, still running that marathon with vigor. But if it's weak, if it's showing cracks in the foundation, that could signal trouble, maybe even whisper the dreaded R-word recession. And you know how the market reacts to that kind of news, like a cat on a hot tin roof. So keep your eyes peeled at 10 a.m. ET. This isn't just data, it's ammunition for your investment decisions. Knowing this number before the rest of the crowd gives you an edge, a real tangible edge. Don't be caught napping on this one, folks. This is where the smart money gets its clues. Are you smart money? I think you are. Next up, looking ahead just a little bit, we've got the granddaddy of all inflation reports, the United States Consumer Price Index, the CPI, anticipated this Friday, June 6th. Booyah! This is the one that keeps Jerome Powell up at night, tossing and turning, probably sweating through his pajamas. Is inflation finally tamed? Is the beast back in its cage, purring like a kitten? Or is it still roaring, ready to devour our purchasing power and send the economy into a tailspin? This report, people, is absolutely critical. It dictates Fed policy, it moves markets like a hurricane, it affects your grocery bill, your gas prices, everything. You absolutely have to understand what this number means for you and your hard-earned money. This isn't just a statistic. It's a headline grabber that will be on every news channel. So what's the street thinking? What are the whispers in the corridors of Wall Street? If this CPI comes in cooler than expected, ice cold, then we could see a relief rally, a real barn burner, as the market starts pricing in a more dovish Fed, maybe even some champagne corks popping. But if it's hot, if inflation is rearing its ugly head again like a monster from a horror film, then look out below. Crash sound effect. The hawks will be circling, ready to swoop, and rate cut hopes could go up in smoke faster than a cheap cigar. This Friday is a make-or-break day for market sentiment. So do your homework. Understand the components, watch the core inflation, and be ready to pounce or protect your assets. This is where fortunes are made and lost, folks. Don't be on the wrong side of this. Now, let's talk about what the smart money, or at least the betting money, is thinking. Based on current projections, the market is pricing in an approximately 73% probability of a Federal Reserve rate cut in September. 73%. That's a big number, folks, a really big number, almost 3/4. It tells you that investors are desperate, absolutely clamoring for some relief from Powell and the gang. They see the tea leaves, maybe they see some economic weakness on the horizon, or maybe they just want cheaper money to fuel the next leg up in this bull market we've been riding. But remember, probabilities are not certainties. No sir, not even close. Don't go betting your grandma's inheritance on it just yet. This 73% figure is a moving target. It ebbs and flows with every piece of economic data, every Fed speech, every global tremor. If that services PMI we talked about comes in weaker than a kitten, this number could go up, maybe even to 80 or 90%. But if the CPI on Friday is scorching hot, hotter than my last take on a penny stock, this number could plummet. Whoosh, down it goes. So, while it's a useful sentiment indicator, don't bet the farm on it just yet. The Fed likes to keep us guessing. They like to play coy, like a poker player with a royal flush. But the market is sending a clear signal. We want a rate cut and we want it soon. Will they get it? Stay tuned because this is a high-stakes game of chicken between the market and the Fed. Don't blink or you'll miss the action. Alright, let's hop across the pond, folks, to the Eurozone. We've got news on their Producer Price Index, the PPI, which was released today. And guess what? It's indicating a slowdown in inflation at the producer level. Ding ding ding, we have a winner. This is significant, people, really significant. Producer prices are often a leading indicator for consumer prices, so if businesses are paying less for their inputs, their raw materials, their energy, there's a good chance that relief will eventually trickle down to the consumer. This is exactly what Christine Lagarde and the European Central Bank want to see. They've been battling their own inflation dragon, a nasty, fire-breathing beast, and this could be a sign they're finally winning, getting the upper hand. Now, what does this mean for ECB policy? Well, a cooling PPI could give them the green light, the absolute go-ahead, to start cutting interest rates, maybe even before their American counterparts at the Fed. Can you imagine that scenario? The ECB leading the charge on rate cuts, stealing the thunder from Uncle Sam? Ka-ching! Sound of coins falling. That could have major implications for the euro, for European stocks, and for global capital flows. If Europe starts easing while the US is still on hold, you could see money flooding into European assets like water rushing into a dry riverbed. So, this PPI data isn't just some boring European statistic, it's a potential game changer, a real market mover. Keep an eye on Frankfurt, folks, because things are getting very, very interesting over there. Speaking of Europe, let's look at the StockX Europe 600 index. Right now, it's exhibiting stability, holding its ground like a stoic soldier. But don't let that fool you into thinking it's all sunshine and rainbows over there. Oh no, investors in Europe are cautious, they're tiptoeing, they're walking on eggshells, scared of making a wrong move. Why? Because of those ongoing trade negotiations. Thunderclap sound effect, dark clouds forming. We all know how trade wars and tariff threats can throw a monkey wrench into the market machinery, grinding everything to a halt. One bad headline, one tough tweet from a world leader, and that stability could vanish faster than a free beer at a ball game on a hot day. So while stable sounds good, it's a nervous stability, a holding your breath kind of stability. These trade negotiations are the elephant in the room for European markets, a giant looming presence. Companies in the StockX 600, many of them big exporters, are heavily reliant on global trade. So any hint of protectionism or new tariffs sends shivers down their spines, right to their corporate core. They're looking for clarity, they're looking for certainty, but right now, they're getting a whole lot of maybe, and we'll see, which is market poison. So, while the index might look calm on the surface, like a duck gliding on water underneath, there's a lot of paddling, a lot of anxiety, a lot of churning. My advice? Don't get complacent with European stocks. Know what you own, understand their exposure to these trade risks, and be ready to react if those negotiations go sour. Skirt, sound of tires screeching, danger ahead potentially. Now let's jet over to Asia, specifically South Korea, where presidential elections are taking place today. This is huge, folks, not just for South Korea and its dynamic economy, but potentially for the entire cryptocurrency sector. Why, you ask? Because South Korea is a hotbed of crypto activity, a real innovation hub, with some of the highest crypto adoption rates in the world, and the stance of the new president on digital assets could have significant impacts. We're talking about regulation, we're talking about taxation, we're talking about whether they embrace crypto with open arms or try to stifle it with red tape. This is a pivotal moment, people, a real fork in the road for crypto in that incredibly important region. The tension is electric. Depending on who wins this high-stakes election, we could see a more crypto-friendly environment, leading to more investment, more innovation, maybe even a surge in certain Korean crypto projects that could go to the moon. Rocket ship sound effect, blast off! Or, if a more skeptical candidate takes the reins, someone who views crypto as the Wild West needing taming, we could see tighter controls, more red tape, and a chill wind blowing through the crypto markets there, sending prices tumbling. Ice-cracking sound effect, freezing. This election outcome is a wild card, a real unknown, a potential black swan. So if you're playing in the crypto space, especially with assets that have strong ties to South Korea, or are popular there, you better be watching these results like a hawk watching its prey. The future of K-crypto could be decided today. Don't miss it. Staying in Asia, let's look at the broader Asian markets. What's the mood over there? Well, they're displaying moderate volatility. Not a full-blown panic, not a wild stampede of bulls or bears, but definitely some nervousness, some jitters, like someone waiting for exam results. Investors there are like cats on a hot tin roof, pacing back and forth, waiting for two big things: those South Korean election results we just talked about, which could send ripples across the region, and of course the upcoming US economic data, that crucial services PMI, and the all-important CPI. It's a double whammy of uncertainty, and markets hate uncertainty more than anything. They crave clarity, they need to see the path forward, but right now, it's a bit foggy, like driving in a pea soup fog. So, you're seeing some cautious positioning, some profit-taking perhaps, as investors try to de-risk ahead of these major event catalysts. Nobody wants to be caught offside if the news is bad, nobody wants to be holding the bag. Think about it. A surprising election result out of Korea could send ripples through regional tech stocks or crypto-related equities, causing chaos. And weak US data could signal a global slowdown, which is bad news for export-driven Asian economies that rely on selling their goods to America and Europe. So, the watchword in Asia right now is caution. They're waiting, they're watching, and they're ready to react at a moment's notice. This is a time for careful navigation, not reckless abandon in those markets. Proceed with care. Let's take a trip to the Middle East, where the Dubai and Abu Dhabi markets are absolutely on fire, folks. We're talking gains for the second consecutive day. What's fueling this incredible rally, this gusher of green? Two words, my friends, two powerful words: energy and tourism. These sectors are red hot, hotter than the desert sun at high noon, and they're pulling the whole market up with them like a powerful locomotive. When oil prices are strong, and they are looking robust right now, these economies boom, tax revenues soar, and confidence is sky high. This isn't just a blip on the radar, this is a trend, and smart investors, the ones who do their homework, are taking notice. The money is flowing, and the sentiment is decidedly bullish. And it's not just oil, my friends, not by a long shot. Tourism is back, baby, back with a vengeance, like a blockbuster movie sequel. People are traveling, they're spending their hard-earned cash, and destinations like Dubai and Abu Dhabi, with their world-class attractions and luxury offerings, are reaping the rewards hand over fist. This creates a virtuous cycle. More tourists mean more revenue for hotels, airlines, and retail, which boosts corporate profits and, you guessed it, stock prices. So, while other parts of the world are wrestling with uncertainty and economic headaches, the UAE markets are showing some serious strength, some real muscle. This is a pocket of opportunity, a green shoot in the global economic landscape. Don't ignore what's happening in Dubai and Abu Dhabi. There's real momentum there, real money to be made. And sticking with the UAE for a moment, let's talk about something shiny, something precious, something that has captivated humanity for millennia. Gold. Gold prices in the UAE are on the rise. This isn't happening in a vacuum, folks. This isn't some isolated event. It's reflecting the global trend of increasing gold prices, a worldwide phenomenon. When there's uncertainty in the world, when inflation fears creep into the minds of investors, when currencies look a little shaky and unreliable, where do people turn for safety? They turn to the ultimate safe haven, the store of value that has stood the test of time, the shiny yellow metal that's been prized for millennia: gold. And the UAE, being a major global gold hub, is seeing that demand reflected clearly in local prices. Whether you're buying exquisite jewelry in the bustling souks of Dubai, or investing in hefty gold bars for your vault, the price is up. and that tells you something profound about the global economic mood. People are seeking safety, they're hedging their bets against turmoil, they're looking for an anchor in stormy seas. This rise in UAE gold prices is a barometer of global anxiety, but also a testament to gold's enduring appeal and its historical role. It's a physical asset, something you can touch, something that holds its value when paper assets might be faltering or going up in smoke. So when you see gold prices climbing in a major international center like Dubai, pay close attention. It's another crucial piece of the puzzle in understanding the bigger picture of where smart money is flowing. Gold is glowing right now, folks. Now let's zoom out from the UAE and look at the global gold price, the big kahuna. We're talking approximately $3,356 per ounce. $3,356. Booyah! That's a heck of a price. Gold recently hit a 4-week high on June 3rd, a real screamer, a beautiful sight for gold bugs everywhere. But hold your horses, don't get too carried away just yet, because after that magnificent run, that glorious ascent, prices have retreated slightly, pulled back just a tad. Why, you ask? Two main culprits as usual: a strengthening US dollar, which makes gold more expensive for buyers using other currencies, and some good old-fashioned profit-taking. You can't blame traders for cashing in some chips after a big move-up, can you? So, the million-dollar question, or rather the $3,356 question, on everyone's mind is this pullback a temporary breather, a mere pause for breath before the next leg up in this golden bull market? Or is it the start of a bigger correction, a sign that the rally has run out of steam? A stronger dollar typically puts pressure on gold because gold is priced in dollars globally. But the underlying reasons for gold's appeal, those persistent inflation fears, the geopolitical tensions simmering around the world, continued central bank buying, those haven't gone away. So, while we might see some short-term wobbles, some jiggles and wiggles in the price, I'm still a believer in gold as a core holding in these uncertain, topsy-turvy times. This slight retreat could even be a buying opportunity for those who missed the last run-up. Think about it. Opportunity knocks. Alright, let's shift gears dramatically from ancient gold to digital gold, the king of crypto, the one and only Bitcoin. BTC is currently trading around $104,796. $104,796 for a single coin. That's after a recent peak of approximately $112,000. What a ride! We've seen some serious volatility, some heart-stopping ups and downs, some gut-wrenching swings that would make a lesser investor turn green and run for the hills. But this is Bitcoin, folks. This is the Wild West of finance, and volatility is the name of the game. If you can't handle the heat, get out of the crypto kitchen because it's always cooking in there. But here's the kicker, the real story behind the price swings. Despite the recent price action, the dips and the rips, institutional adoption remains strong. Unbelievably strong. Companies like MicroStrategy, led by the ultimate Bitcoin bull, Michael Saylor, are continuing to accumulate Bitcoin, buying more and more, gobbling it up like there's no tomorrow. They're not scared by these dips. They see them as prime buying opportunities. This tells me that the big money, the smart money, the institutions with deep pockets still believe fervently in Bitcoin's long-term story. They see it as a hedge against inflation, a store of value for the digital age, a revolutionary technology that's changing the world. So, while the price might dance around like a crazy person, the underlying trend of institutional embrace is a powerful tailwind. Don't let the short-term noise distract you from the long-term signal. Finally, let's talk about the elephant in the crypto room, the topic that gets everyone fired up: regulation. This is a huge deal, folks, absolutely massive, and we're seeing some major game-changing developments on both sides of the Atlantic. In the US, get this, the government has established a strategic Bitcoin reserve, holding approximately 200,000 BTC, 200,000 Bitcoin in Uncle Sam's pocket. This is a monumental step, people, a landmark decision. It signifies a recognition of Bitcoin as a national reserve asset, not just some funny internet money. This isn't just some fringe internet fad anymore. This is Uncle Sam saying, okay, Bitcoin, you're legit. You're part of the system now. This could pave the way for more clarity, more adoption, and much more institutional comfort with crypto. Meanwhile, over in the European Union, they're implementing the Markets in Crypto Assets, or MiCA regulation. The goal here, they say, is to provide legal clarity for digital assets, to create a comprehensive framework for the secure adoption of blockchain technologies across the continent. Now, some crypto purists, the hardcore libertarians, might scream, "Regulation bad, government overreach." But listen to me, Bruno, for a second. Sensible regulation can actually be good for the industry in the long run. It can foster trust, it can protect investors from scams and fraud, and it can encourage mainstream adoption by making everyday folks feel safer. We're moving from the Wild West era of crypto to a more mature, regulated market. This is a sign of crypto growing up, putting on its big boy pants, and that's ultimately bullish for the long term. The game is changing, and you need to understand these new rules to play and win. And that's a wrap, folks. A whirlwind tour of the global economic landscape for June 4th, 2025. We covered a ton of ground, from PMI pulses in the US that tell us about economic health, to PPI pronouncements in Europe hinting at ECB moves, from election anxieties in Asia that could shake up crypto, to critical crypto regulations taking center stage worldwide. Phew, my head is spinning with all that information, but hopefully, yours is filled with actionable insights and a clearer picture of where the money is moving and why. Remember, in this game, knowledge isn't just power, it's profit. The markets are a constantly shifting beast, a dynamic, ever-evolving puzzle with a million pieces. But if you do your homework, if you stay informed, if you listen to voices that cut through the noise like yours truly, Bruno, you can navigate these treacherous waters and come out on top with your pockets full. Don't be scared of volatility, embrace it as an opportunity to buy low and sell high. Don't follow the herd like a sheep to the slaughter. Think for yourself, be a lone wolf, and most importantly, never stop learning, never stop questioning, and never stop striving to make your money work harder for you, day in and day out. That's all for today's global economic calendar. Stay tuned for more updates and market insights. Don't forget to like, share, and subscribe for the latest in global economic news. Hit that notification bell so you don't miss a single update from me. This is Bruno, urging you to stay vigilant, stay informed, and as always, go out there and make some money. Booyah! See you next time.